Welcome to Talk Tickers. We're your shortcut to getting smart on the latest earnings calls.
That's right, making sense of the numbers and the stories behind them.
Today, we are diving deep into Dollar Tree's Q2 fiscal 2025 earnings call. It just happened, September 3rd.
Yeah, fresh off the wires.
And this quarter, it wasn't just about solid performance, operationally speaking. There were some really big strategic moves happening.
Definitely, a lot shifting under the surface.
But here's the interesting part. The market reaction, it was, well, pretty different from what those headline numbers might suggest.
That's what makes this one worth unpacking, I think.
Exactly. So our mission here is to cut through that noise, pull out the key insights from the call. We want you to understand not just the numbers, but the strategy, the narrative, and really what it means for where Dollar Tree is headed.
It's that classic story, isn't it? Strong underlying business, but maybe some market perception issues or short-term concerns weighing things down.
Precisely. So let's kick off with a quick look at those results because, like I said, on paper, Q2 looked really strong, beat expectations.
Yeah, pretty much across the board.
Normally, you'd expect the stock to pop on that kind of news, but instead, we saw a notable downturn. So why?
Well, the beats themselves were pretty significant, caught a lot of people by surprise, I think. Adjusted EPS, earnings per share, came in at 77 cents.
77 cents.
Which just blew past the consensus estimate. FactSet, the street, they were looking for something like 42 cents.
Wow, that's a huge beat, almost double.
Huge beat, yeah. And revenue was strong, too. $4.57 billion. That's up 12.3% compared to last year. And it beat estimates by about, call it, $0.09 billion or $90 million.
Okay. And the comps. Comparable store sales.
Also very strong. Dollar Tree banner comps were up 6.5%.
Better than expected.
Oh, yeah, much better. The street was looking for maybe 4.9% growth there, and it was driven by both more people coming in traffic and people spending more ticket size.
Okay, so strong EPS beats, strong revenue beats, strong comps. Yet the stock closed down, what, over 8% after the call?
Yeah, that's the disconnect.
So it mostly came down to the outlook, the guidance for Q3.
Exactly. This is the crucial detail. Q2, while it looked great, got a boost, about 20 cents per share. An EPS tailwind, you could call it.
Tailwind? From what?
It was mostly timing related to tariffs, when the import duties hit the books, and also some initial margin benefits on new products, what they call mark-on initiatives.
Ah, okay, so
Yeah.
that temporary stuff.
Right, and management was really clear about this on the call. They explicitly said that 20-cent benefit, it's going to reverse in Q3.
So the market heard strong Q2, but immediately thought weaker Q3.
Pretty much. They looked past the Q2 beat and focused on that timing difference, that reversal hitting Q3 earnings. That drove the cautious or, negative reaction.
Okay, let's unpack the actual Q2 performance then, because under that market reaction, the core business seems, well, pretty solid.
Absolutely. It was solid.
You mentioned the comps growth was balanced, traffic up 3.0%, average ticket up 3.4%. That's healthy.
Very healthy. It shows it wasn't just one thing driving the growth.
And it was across the board too, right? Consumables and discretionary?
Yeah, consumables were up 6.7%, and discretionary goods, things people want rather than need, were up 6.1%.
And that 6.1% for discretionary, that's actually a 2-year high for them, isn't it?
It is. They highlighted strength in electronics, hardware, lawn, and garden, areas where maybe you wouldn't always think of Dollar Tree first.
So they're getting more people in the door, those people are spending more, and they're buying a wider range of stuff. Sounds pretty good.
It really does. And this connects directly to who is shopping there now. Over the last year, Dollar Tree added 2.4 million new customers.
Okay.
And get this, 2/3 of those new shoppers came from households earning $100,000 a year or more.
Wow, 2/3. That's up from Q1, right?
It is, yeah. It accelerated. In Q1, it's closer to 50%. So that trade-in effect, where higher income folks are choosing Dollar Tree for value, seems to be picking up steam.
So broadening their appeal significantly.
Definitely. And it's not just new customers. Their existing shoppers are coming back more often. Visits from people shopping 3 or more times a month, up 11% in Q2. Shows growing loyalty.
And what about pricing? They've been introducing those multi-price points, the Dollar Tree Plus idea, now the 3.0 format. How's that going?
Seems to be going well. They started some selective price increases late in Q2, and the customer reaction, they said, was actually positive. Less impact on the number of items sold, the unit volume, than they initially worried about.
That's a good sign, gives them flexibility.
It does, especially when consumers are being cautious with their spending.
Okay, let's touch on margins. Gross margin improved.
Yeah, up slightly.
Hmm.
by 20 basis points, so 0.2% compared to last year. Came in at 34.4%. That was mostly driven by lower costs for the goods they bought and those pricing actions helping out.
But operating margin was down slightly.
Right, because the overhead costs, SG&A, went up, increased by 60 basis points to 29.6% of sales.
Why was that?
Mainly higher store payroll, wage increases, which everyone's dealing with, and also higher general liability costs. That seems to be an industry-wide pressure point right now. So, yeah, higher gross margin, but offset by higher operating costs, leading to that slight dip, 20 basis points, in operating margin overall.
Okay, now here's where things get, I think, really interesting. The strategy side.
Yes.
The biggest news, maybe the defining move of the quarter, was finally completing the sale of Family Dollar. That closed July 5th.
Huge moment for them.
This feels like more than just a transaction. It lets Dollar Tree be, as they put it, fully focused on the core Dollar Tree brand. What does that really mean strategically?
It's massive. Think about it. For years, they've been juggling two different banners, two different customer propositions, complex supply chains. Family Dollar was always a bit of an awkward fit after the acquisition. Different price points, different store formats.
A drag on resources and focus.
Absolutely. A drag on management attention, on capital allocation. Now, they can pour everything, money, time, strategy, into optimizing the Dollar Tree brand itself. It simplifies everything. One ship to steer, like you said earlier.
And that sale brought in quite a bit of cash, right? Helps the balance sheet.
Oh, significantly. They got $668 million in cash right away from the sale. Plus, they expect about $425 million in cash tax benefits from the sale itself. And on top of that, another $700 million in faster cash tax benefits thanks to a recent tax bill. So a lot of liquidity unlocked.
What did they do with all that cash?
Put it to work quickly. Paid off a $1 billion senior note debt reduction, always good. And they refreshed their share buyback program, adding another $2.5 billion to the authorization.
So paying down debt and signaling confidence to return cash to shareholders gives them a lot of flexibility.
Tremendous financial flexibility. All focused now on that single Dollar Tree engine.
And a key part of focusing that engine is speeding up the rollout of this 3.0 multi-price format, right?
Exactly. That's central to the strategy now. They converted about 585 stores to that format just in Q2.
Bringing the total for the year so far to?
3,600.
Yeah.
And they're aiming for 5,000 conversions by the end of this fiscal year. So they're moving fast.
What does that 3.0 format actually allow them to do differently?
It's a game changer for their assortment. They can offer larger pack sizes, better value on staples. They can bring in better quality items and entirely new categories they just couldn't touch at the strict $1.25 first point. Like they mentioned selling $5 hammers now.
Right. So it attracts a wider range of shoppers, those higher income folks we talked about.
Precisely. It meets more needs for more people, driving traffic, driving that average ticket size up without losing that core identity of value. It's a smart evolution.
They're also innovating outside the store walls, looking at partnerships. The Uber Eats deal sounds interesting.
Yeah, that just launched nationwide in late August across about 9,000 stores.
Giving them access to potentially 25 million Uber Eats users.
Exactly. It's a totally different channel, potentially reaching a younger, maybe higher income customer who might not walk into a Dollar Tree otherwise.
Convenience play, but also a customer acquisition play. Early days, but they said the response was encouraging.
It's one to watch. Digital access is key these days, even for dollar stores.
Now, they're doing all this against a tough backdrop. You mentioned tariffs earlier. That's still a headache.
Oh, yeah. Big time. Tariffs on goods from China are still at 30%. That's a major sourcing country for them. And it's not just China. They said rates from other places like Vietnam, India, Bangladesh have also gone up meaningfully. So cost pressures are real.
How are they fighting back against that?
They have this 5-lever strategy they talk about. It involves negotiating hard with suppliers, changing product specs to lower costs, shifting production to different countries where possible, dropping items that just aren't making money anymore with the tariffs.
Well,
And then, only as a last resort, taking selective price increases.
and they feel these are working.
They call them effective mitigation techniques. So they believe they can manage it, but it's definitely a headwind they have to constantly battle.
And besides the big strategic stuff, they're still focused on the basics, store experience.
Absolutely. They mentioned their Road to Gold initiatives are ongoing, focused on improving store conditions, making them cleaner, better stocked. And a preventative maintenance program actually cut down the number of days stores were closed for repairs by 15% year over year.
That stuff matters. A closed store makes zero sales. A messy store turns customers away.
Exactly. Foundational blocking and tackling that supports everything else.
Okay, so let's circle back to the investor reaction then. We have strong Q2 results, strategic progress selling Family Dollar, accelerating the 3.0 rollout, new partnerships. But the market hammered the stock.
Yeah, it's fascinating, isn't it? The market just seemed laser focused on that cautious Q3 outlook, expecting adjusted EPS to be roughly flat year over year.
All because of that Q2 tariff timing benefit reversing.
Primarily, yes. That 20-cent headwind hitting Q3 seemed to overshadow everything else for traders in the immediate reaction. It's a very near-term focus.
What about the full year? Did they update the guidance there?
They did. For the full fiscal year 2025, they're now guiding for net sales between $19.3 and $19.5 billion. That implies comparable store sales growth, still in the range of positive 4% to 6% for the year.
So comps still look pretty healthy for the full year.
Yes, and adjusted EPS for the full year is expected between $5.32 and $5.72. But crucially, they noted this assumes tariffs stay where they are now and that their mitigation efforts continue to work.
So still some uncertainty baked in there.
Definitely. But management, on the call, they really tried to emphasize the bigger picture, the structural improvements, the simplification after selling Family Dollar, the long-term potential.
They even announced an investor day, right? October 15th?
Yes. To lay out the refreshed long-term strategy for the standalone Dollar Tree business, they clearly want investors to look beyond Q3.
But the market, at least initially, wasn't buying it, stuck on the short term.
It seems that way. It led to that classic beat, raise, but stock down scenario. Good results, okay guidance overall, but the stock tanks because of one specific near-term worry or because expectations were just sky high.
So pulling it all together, what does this mean for you, the listener, trying to make sense of it?
Well, Dollar Tree is clearly navigating a tricky environment. Consumers are cautious, especially lower-income ones. Input costs like tariffs are a challenge.
But value and discount retail generally does what in these kinds of environments, right? People trade down.
Exactly. That sector continues to gain market share. And Dollar Tree, with its sharpened focus and evolving model, seems pretty well positioned if they execute well and manage those cost pressures.
The big question is whether the market will eventually look past the Q3 noise and focus on that longer-term potential.
That's the million-dollar question, or maybe the $5 hammer question now.
All right, now for our segment where we offer a perspective, maybe even a slightly provocative one.
Yeah.
But remember, this segment is for educational and entertainment purposes only.
Absolutely.
Yeah.
Please consult a financial professional before making any investment decisions. We are not endorsing any specific trade. Got it.
Got it. So what's the outrageous but plausible take here?
Okay, look. The market, in our view, really overreacted to the Q3 guidance. It punished the stock severely, focusing almost entirely on that temporary tariff timing issue. They seem to ignore the massive structural improvement from selling Family Dollar, the accelerating 3.0 rollout success, the potential of Uber Eats.
So you see an opportunity.
We think this short-term dip could be a compelling contrarian opportunity. The market's fixated on a temporary headwind, missing the bigger picture. So one idea, again, not advice, is you could consider building a long position in the stock, DLTR.
With a catalyst in mind.
Yeah, keep a close eye on that upcoming Investor Day on October 15th. We expect management will use that platform to really hammer home the long-term earnings power of this leaner, focused Dollar Tree. They'll talk about the 3.0 format driving growth, the Uber Eats partnership reaching new customers, and how they are managing tariffs with those 5 levers.
So the thesis is, the market is missing the forest for the trees right now.
Pretty much. This isn't just about muddling through. We think Dollar Tree is actively gaining share in an environment where value wins. They're agile. They're focused. The market seems to be overlooking that strength because of a short-term blip.
Okay, that's definitely a contrarian take given the stock reaction. Let me push back a bit, though. What if the market's right to be cautious?
How so?
What if those tariff headwinds get worse than expected? Or what if the consumer, even the higher income one, pulls back spending more sharply? What if Uber Eats just brings convenience orders but doesn't translate to more store traffic long term? Could the Q3 weakness linger?
Those are absolutely the right questions to ask. The risks are real. Tariffs are unpredictable. Consumer behavior is shifting. But look at their track record. The 5 levers for tariffs isn't a new invention. They've been using and refining that playbook. They've shown they can adapt. And with Uber Eats, look, even if only a small percentage of those millions of users become loyal customers, either delivery or in-store, it's incremental revenue they didn't have before. It expands their reach.
So you're betting on execution and the strategic direction outweighing the near-term macro risks.
We think the direction is key. A focused company, clear strategy, gaining share in a favorable sector. The market seems fixated on the rearview mirror or maybe just the next quarter mile, while management is trying to map out the whole road trip. We think the potential upside from getting the strategy right outweighs the known risks.
Okay, so let's summarize this deep dive then. Dollar Tree put up strong Q2 numbers, beat expectations.
Yep, solid performance.
They completed a massive strategic move, selling off Family Dollar to focus entirely on the core brand.
Check. Streamlining the business.
They're rapidly expanding the multi-price 3.0 format and reaching new customers via Uber Eats.
Check. Investing in growth and reach.
But the market focused heavily on the Q3 guidance, specifically a temporary headwind from tariff timing reversal, sending the stock down.
Right. Short-term pain overshadowing arguably long-term gain.
Which leads us to the final thought.
Yeah, the really critical question for you as you watch this unfold, especially heading into that October 15th Investor Day, is this. Will the market start to buy into this cleaner story? Will they appreciate the structural changes, the sharper focus, the long-term potential? Or will that near-term noise, the tariff volatility, the quarter-to-quarter EPS worries continue to dominate the narrative and hold the stock back even as the company makes progress?
Will the market see the forest for the trees? Something to think about.
Definitely.
Thank you for joining us on this Talk Tickers deep dive into Dollar Tree's Q2 call. Think about what stood out to you, how you interpret these moves.
Yeah, mull it over.
Until next time, stay informed.